Hey, good morning, everyone. Again, my name is Eris Katz. Welcome to our first webinar in a series of upcoming webinars as we launch new products to market. I'm excited to be joined today by two of my colleagues, as well as our data partner, Owl Analytics. Ben Webster is here, and I'll give him a chance to tell you about himself in just a second. Just a few points of logistics before we get started. I want to quickly go through the agenda today, but also we'll start with the disclaimer and some of the legalese here. So for those of you who are, I'm sharing my video. Obviously, you can read the disclaimer here. Most important thing is that we're going to be presenting today some backtest simulation, some paper trading simulation. All of these are hypothetical. All of these, we try our best to include our fee structure and transactions costs and slippage. But obviously, when you have a simulation, there's always subjectivity and this chance of look back or look ahead bias. So please take everything as hypothetical. Nothing is proven and nothing is indicative of future returns. I'm going to go to page number 2 here, which explains a little bit more about our backtest simulations. How we conduct our backtests, what the fee structure that we apply to discount the returns to make them as authentic as possible. But we want to make sure you guys realize that. And of course, our model portfolios, which are paper traded simulation that can be synced in real time with a true broker account, are also including our fee structure, a net of our fee structure. As you can see here, it's 40 basis points plus 10%. Performance in excess of 8% hurdle. Anyway, that's just a logistics disclaimer. Let's get started. Let me go into presenter mode here and we can get started. So just to underscore today's webinar, it'll be about 40 minutes, 45. We're going to try and leave some time at the end for Q&A. If you have any questions, please do not hesitate to use the Q&A icon on the Zoom webinar. I'm joined here by my colleagues, Eric Davidson and Kathleen O'Daly. Eric would be presenting alongside with me, as well as Ben Webster from Owl Analytics. Just to get the intro started, I'm the CEO, co-founder of Neurovests. We are a technology fintech company, a research company, but we also deal with asset management. We'll talk about that in a second. Let me give a chance for Eric to tell you about himself, and then we'll go into Ben Webster and we'll start the webinar. So Eric, please.
Thanks, Eris. Yeah, I run strategic partnerships here for Neurovests. My role is twofold. One, I reach out to the marketplace and develop relationships with unique alternative data providers. And two, I help commercialize products as a channel partner with the data providers once we're in production.
Thank you, Eric. Let's move on to Ben. Good morning, Ben.
Hi, good morning, everybody. My name is Ben Webster. I'm the CEO of Owl ESG. We are a ESG data and research company, and we work with institutional investors and financial institutions across the world. And I'm happy to be here and talk about what we do and support Neurovest in what they've built with our data. Thank you.
Excellent. Thank you, Ben. Let's just get started. So a little bit about Neurovests and who we are. So we are a fintech company. We research data providers. Essentially, that's how we started. But we actually have implemented the concept called adaptive AI. And the idea behind adaptive AI is to build models that are basically perpetually learning and self-adjusting with fresh data and constant reassessment of their empirical performance. As you know, the market is very dynamic. Machine learning problems that you solve with other industries have what we call a stationary problem that you go after. We actually have adapted the concept of consistently changing and adapting to the market conditions to basically create alpha situations in any market. We believe that data is the bloodline of AI, and in order for us to create models that are effective, data is empirical, is important, and for empirical validation as well as for perpetual validation. And Owl Analytics is one of the data sets that we have assessed and evaluated from ESG perspective. We found it to be very interesting, and we want to show you today why we have teamed up with our ESG, and why we think the ability for us to create winning strategies, or seek to create winning strategies using unique data with obviously a trend that the market is indicating you need to be involved in. A little bit more about our business model. So as you can tell, data providers are the fuel that feeds our AI engine. We have this concept called, refinery. We take basically raw data and try to isolate the important part of that data. Of course, validate it in sample and out of sample, which is essentially periods of time by which you create your hypothesis and you validate it on a different period of time. We'll talk about that in a second. Today, we have, I would say, a dozen or so active data providers that we've teamed up with. There's about 40 of them that we've established with them relationships. We keep adding new data sets and new capabilities all the time. OWL is one of the first ones for us to launch this new set of products, and we'll tell you in a second why. The notion of our business model is that we basically create a partnership with the data providers. We actually both benefit if we actually are able to deploy capital, whether it's our own or our customers. So why go after ESG? Obviously, we're not ESG experts. We're not going to talk about the legal and the compliance and the legislative arm of ESG. We basically rely on our data providers to provide that expertise. Where we fit in is where we see the market that has to respond to ESG compliance, whether it's going to be that corporation will be forced to create compliance on all three levels of ESG. And we think that having the assessment of companies that are in best compliance on either one of those categories does provide opportunity for alpha. So it's not just investment for good, it's investment for profit. And we'll talk about that today. We think that the investors in general have to anticipate the environment changing, because of the new millennials that are really pushing that narrative, and the new generation of young investors, and companies are being forced legislatively, but also from business practice to comply with ESG standards.
Thank you, Eris. I'll grab this one. We identified 3 challenges when we decided we wanted to integrate ESG into an investing framework. The first is ESG is highly subjective. There isn't yet a common language for scores and ratings, so we needed to find a way to address that and hopefully overcome that. 2, we wanted ESG data that's feature-rich so that we can create a range of strategies based on different customer mandates and risk tolerances with the customers on the buy side and active management space that we work with. And 3, we want to outperform benchmarks. And so we developed a relationship with Ben and Al, and Al checked two of those boxes for us. Al aggregates hundreds of data sources and generates a consensus from that collective intelligence. And the result is more objectivity and less subjectivity in the scores. And 2, it's feature rich. It has multiple KPIs in each broad category of E, S, and G. And so that allows us as an ML shop, an AI shop, to really customize at scale. We can build thematic portfolios, but then working with each manager, many of which who have their own mandates and their own risk controls, and so they need tilts that are in different ways. That feature richness in the KPIs really helps us achieve that goal. So I'll kick it over to Ben to provide a little bit of detail about those KPIs on the next slide.
Hi, everybody. This is Ben Webster, obviously from OWL, as Eric said. We, kind of reiterate what Eric said. We aggregate hundreds of sources of ESG data, including many of the most well-known ESG research and ratings vendors in the business. And their scores differ from each other. So they could have two scores on the same company. One could rate Tesla actually low on environmental. One could rate Tesla high on environmental. And there's a lot of reasons for that, primarily related to which ESG issues each vendor thinks are relevant for a particular industry. They all have different views. So we aggregate those data sources and find that consensus view of the metrics that the group thinks is relevant for each industry and each company. And these are these relevant ESG metrics that the group thinks are relevant for a particular company and industry are then aggregated into what you see here, our KPIs, right? It's pollution prevention and climate change, environmental transparencies. How transparent are they being about their environmental performance? How they affect the world and climate change, et cetera, and their policies to stop that. Resource efficiency, how efficient are they being with their natural resources? And you could go through the list. These are human rights, diversity and rights, community and charity, how ethical the management of the company is, how effective the board is at making sure that the company is governing itself well and actually trying to achieve their ESG goals. Right. These are themes that that anybody can get behind. Companies that are doing these things are working hard to make obviously make money and make profits, but while at the same time hopefully reducing their negative impact and actually hopefully also producing a positive impact above and beyond the jobs they create, et cetera. And so those are the metrics that Neurovest is using to create investment strategies with our data.
Thank you, Ben. Aris, we'll kick it back over to you.
Thank you. That's excellent. So let me quickly get into down to the research process. So as we deploy new model portfolios, and our business model is basically to create model portfolios that basically have human intuition driving them, but they actually execute algorithmically. So all the decisions are made through data and AI. The day-to-day operations is really done algorithmically, automatically. We think machines can do a much better job using statistics than human on their own, although humans, again, provide the intuition to building any type of models that we created. The idea generation is the first step, obviously. At that point, we collaborate with the data science team. The data science team has to evaluate the data. Number one, assess which data sets are most suitable. ESG, obviously, we identified several data companies, and OWL is one of them that we found to be very, very effective. Once it's validated, it moves into the quant team, by which they can create what we call features from the data. These are the indicators that are going to allow us to make decisions in real time as to which companies, which stocks, which corporations are most suitable for the theme that the model is trying to execute on. We create a model portfolio, and obviously we go to market. And this is kind of the stage where we are here. The OWL Analytics ESG model is actually new. It's been about a month and a half in production. But the whole notion is that once you go to production, it never sits still. You always iterate and update to make it better. And again, the adaptive AI concept is that the machine is able to adapt automatically, learn from its mistakes, fix them through historical assessment, but also as you get new data, learn more and get better over time. Okay, so let's talk about the type of data and how we evaluated the data. So the first thing we do before we do anything else is we have 12 check boxes that we want to make sure they cover as we evaluate the data. The first one is obviously structurally, the data is sound, is consistent, there's no NANs, there's no survivorship bias. There's a whole bunch of stuff that we do in the DQE, data qualification engine. It's one of our platform components that allows us to travel through the data very quickly and identify if it's predictive or not. But once we pass that, we look at the data in a very naive and rudimentary way. What you see here is we've taken actually all the categories that Ben and Eric described in earlier slide, and basically try to break down the values normalized to quintiles, so 5 ranges of values for each one of those categories. And then we basically break down the categories and assess the market relative performance of the positions that respond to any of these categories, that fall within these categories. So you can see, just by looking at this little heat map here for one of the categories, CIT1, you can see that the top quintiles by far outperform the bottom quintiles. I mean, that's just structurally telling us that the data has value, has some notion of information. We haven't really dug into the specifics yet, but this is just a good confidence measure that we see the average return of the positions is, again, these are absolute returns, but we look at market relative returns, is by far more consistent on the top deciles versus the bottom ones. It's very clear to see that. There's a lot of course, work that's done beyond that. I'm trying to simplify it just to show you kind of what we go through and how we evaluate data. So once we've done the quantiling scores, we can actually start to look at smoothing out the data and reducing the noise and breaking down to a more granular breakdown of information. The quintiling of different scores over various time periods as well. We'll look at 1 month, 3 months, 6 months, 12 months, 18 months, and 24 months, time horizon. Again, with the concept behind ESG is not something you go in and out of position every day. These are much low turnover models because those scores, as we identify how they respond, correlate to returns, tend to basically persist as outperformance for a long time, not just for a 1 day, 5 day type of thing. So these are really more for the low turnover, greater look forward projections. The fine tuning of the strategies have to be also what we call industry neutralization. Let me explain what that is. As we were evaluating the ESG scoring, we noticed that certain companies appear to cluster into the top quintiles that are all of the same industry code or industry sector. For example, technology has been, at the top tiers for a while. Energy, have been in the bottom tiers, obviously for good reasons. Most of you can understand. But we try to basically neutralize that consistency or the concentration on the sectors. And what we've done here is we made sure that we have representation of every sector equally as we bin those qualifications. You can see, again, even after neutralizing those sector representations, we still have a very strong, assessment that the top quintiles on both the industry sectors and the returns are focused on the bottom right corner here, which is, again, a very good sign that we have information that's not just lucky to be on a sector that's been performing really well in that time frame, but really all the sectors that represent scoring and isolating the score of the ESG factors. And it's important to note that because, as you all know that, correlation does not always derive from causation. We try to isolate the outperformance and make sure that it's actually represented best through the ESG data as opposed to just general market conditions. That's why we've done this industry neutralization that you see here. We've done, of course, much more robust and deep analysis beyond that, but I just wanted to show you what we go through to validate data and actually deploy it to production. What I'm going to show you now is basically our analysis. This is really not a performing portfolio, so don't take these back tests as the results of a live portfolio. But what we've done here is assessed before slippage and transaction costs, just to see how consistent the outperformance is for each one of the categories, the E, the environmental category, and then the S and the G. And we'll go through each one of those slides just to show you what's going on. So again, taking those two top quintile that I've shown you before, we try to see how it translates to returns against the benchmark, which is the S&P 500. And you can see that obviously we do have clearly higher performance for the time frame that we've evaluated. So 2016 to October of 21, we kept some time, obviously, out of sample to ensure that it is actually consistent, not in that period, but also as it goes into present, which I'll show you in a second. This is all coming from our platform, by the way. We can generate those reports very, very quickly and be able to identify if there's information or not. So you can see here, again, the environmental piece right here. This is the social. Again, we isolate the categories and look at the year-over-year, returns. So what we've done here, we've said, let's look at the top categories and pick the top constituents that have the highest year-over-year return up to the point of entry. So there's no look forward. Historically, they were best in year-over-year returns and best in the ESG scoring. In this particular one, the social scoring. And you can see here very clearly that we see alpha on the returns, obviously a little bit high drawdown, but again, these are not a true investable backtest, just to see the returns and the correlation to the actual indicators themselves. I want to go quickly through the next slide, which is the governance. And again, the results are more pronounced here. Again, higher drawdown of the positions that we identified, again, is best performing over the past year before we enter the positions. And again, having the highest top 2 quintiles of the ESG scoring on the governance side. And again, you can see that all three have shown outperformance, but with a higher drawdown volatility. And we can actually mitigate that as we get into the final backtest and the final productionalization of the strategy. What you see on this screen here is the combination of all three factors together. This is rebalanced once a month. We get the data updated from Ben, and then obviously apply the changes once a month to reduce turnover. And again, getting closer to what we call productionalization of the strategy to ensure that we're getting in and out of positions only when we need to, not because of some knee-jerk reaction. So you can see here, again, each one of those legs individually represented here. The benchmark is right here in the dark blue. And then as we get into the combination, you can see clearly that we are outperforming together. That's the orange line. And the S&P 500 is the blue line here, which is the benchmark. Okay, let's move on to the next slide, which is actually the more interesting slide. This is a real-time deployment of a perpetual paper trading simulation of that strategy. So there's no historical bias that you can actually insert here, because this is trading on a roll forward basis. And that's the last thing we do before we go live with those models. And you can see as of December 1st, 21, which is when we went live to assess the strength of the strategy, it's been outperforming very nicely the benchmark, a much lower drawdown, a very nice Sharpe ratio. It's a short period of time, so don't take that as gospel. But what we do in turn is actually we can synchronize those model portfolios with the real broker in real time. And that's how we keep all the knowledge and all the intelligence on the platform, but the results are synchronized in milliseconds as we find discrepancy between a destination broker account and our platform model portfolio. So that's kind of the story behind how we went about building the model. I just want to mention, and I'm almost finished here, I want to mention that there's two ways for us to deploy the ESG data that Ben and his team has provided us with. The first easy one is to have a standalone strategy, which is what you saw just presented in the previous slide. But the other one, which is actually a very exciting offering for us, is to make it a leg within a multi-strat diversified portfolio. So think about combining multiple orthogonal, uncorrelated strategies together to support a single fund that has some orchestration from the top that can actually balance between various portfolios and allow you to really leverage the strength of each best of breed at any given time. Let me show you what I'm talking about. What you see here is just a scheme, a schematic view that you can see how it's all done. On the bottom, you can see the silo. These are best of breed. ESG is one of them, but there's other uncorrelated data types in portfolios that can kind of combine together. And there's an orchestration from the top down that identify where should you put your money and how much you should allocate in between them in any given time. The result of that exercise is creating basically a best of breed, silos that can actually get focused on in different times, in the market. And that's the beauty of that top line, to identify macroeconomic factors and other types of global kind of trends to identify where to put the majority of your allocation on and move that around as you need to. And you can actually have short strategies combined to provide hedging as well. And what you see here is exactly an example of that, where you combine those together. You have this really nice accrual of consistent return over the years, and minimizing the drawdown when you have these big drops in the market. The benchmark here is the Russell 1000, and the fund is basically using that combination of multiple data sets that we have incorporated here. This is pretty much what I wanted to share with you. Let me see if there's any questions, and we'll go from there. So let me open up the podium for Q&As. Okay, I see one question from Clifford. Can paper trading strategies be implemented in someone's brokerage account in a hands-off manner for investors? Or do you need investors' permission to make each trade? So the way we operate, the way our business operates, we actually we don't hold custody to any of our customers' account. We basically get what we call power of attorney to execute trades in their behalf. And we can connect. We don't have to get permission. We get complete authority to have the model trade without human intervention. That's just the basic integration. Now, for some of our larger customers who are not keen on having automatic trading, they have a mandate to have a human or a desk do the trading. For them, we provide what we call a smart portfolio feed, which essentially allows them to take the allocations either electronically through an API or through a CSV file, and then run it themselves in the trade execution. These, by the way, specific strategies are very low turnover. So we're talking about sub 300 per year or sub 200 per year percent of turnover. So they really don't change very often. And therefore, you can take that CSV and implement it, on your own terms as you need to. Hopefully that answers your question. Ben or Eric, anything else you wanted to add and mention for the people who actually have joined us today on this webinar?
Yeah, it's important to note that, ESG is subjective, right? And everybody has a different opinion on it. And our scores are constantly adapting to what the major research providers on ESG determine to be the relevant ESG metrics for each company. So what does that mean, and how does it relate to an investment strategy? Well, the sources that power us are upgrading companies, downgrading companies with ESG ratings, and our scores are capturing all those things. Almost, if you could look at our scores, almost like as the market ESG market score of a company, right? The reflection of what the market thinks a company is in regards to ESG. So that will have some effect on stock prices in some way or other. And the hope is that the group that's powering us is capturing that and in turn, Neurovest is capturing the positive effects of what our scores can bring to the investment strategy. And I think what you see here shows that they're doing a great job so far.
Yeah, thank you, Ben. We basically went through some of our goal today was to give you some flavor of what does it take to really take a data set that has high likelihood of predictability and convert that to an actionable, live trading strategy. I haven't really gone through all the details, all the machine learning, all the feature selection, all the training that we do on models to get them really to a good point. But it just was done mainly to give you a flavor of how we take data and make it actionable and investable. We're going to have additional webinars in the near future on additional data sets. We actually are launching some new products as well, so we'll keep you posted. But I want to thank Eric and Ben Webster, who actually has been a great partner. Believed in what we're doing together, and obviously the proof is in the pudding. We actually have something very special together. If anyone wants to look at the data itself, we don't provide the data directly. You should reach out to Ben. We will actually provide contact information after this webinar. There will be also a recording available of that webinar for others to see. If anybody knows of somebody else who did not make it today to the presentation, but I appreciate everybody's participation. And have a great day, and good luck with everything. And we'll see you and talk to you again very soon. Be well.
Thank you. Yes, it's our pleasure.
Thank you, everybody. Appreciate you joining.
Take care.
Bye.
Are we on?